Hey, I'm Brett Hersh. I'm a real estate tax pros and an instructor for overnight accounting. Also, I am the author of our new book, Real Estate Agent Tax Cut Library. It's available on Amazon. You're gonna love it. But today, what I want to say is, this is for information purposes only, you know that drill. What I want to talk to you about just briefly today is real estate agent problem deductions. These are areas where there's a lot of misinformation, a lot of confusion, that when we prepare individuals' taxes, real estate agents' taxes, where we run into problems. So I want to make you aware of them so you can avoid them. Here's your most error-prone deductions that we run into, maybe not the most in the world, but what we see on a regular basis from self-employed real estate agents. Problem 1, auto deduction. Problem 2, meal deduction. Problem 3, home office deduction. And number 4, deducting clothing. Let's go over each one of these problem areas individually and briefly. Shall we? Yes. All right, let's talk about auto problem areas. Biggest problem we see with real estate agents is the age-old issue of keeping the mileage log. Those are required. You're required to keep it contemporaneous. That means at the same time. Not always true, but that's what the regs say. Contemporaneous record of where you traveled. You need to know where you go or where did you travel to, and also you need to document why you went there. Apps are helpful. Mileage IQ, not a plug, but there's a lot of apps out there, and many of your cell phones now, they can track where you're going. There's a lot of apps for that. Those are helpful. But at least, what we tell folks is at least keep a calendar. If you keep a calendar, you know where you went for your showings, you know where you traveled that day, you keep an appointment book, you keep kind of a log, maybe not tracking all the mileage, but at least then you have something. You know where you went, when you went there, and why you went, and at the end of the year you can get Google Maps out or something like that and reconstruct your miles, or monthly. That'll still work. You got a contemporaneous log because you know where you went. Also, good tip. Take a picture of your odometer yearly, at least once a year, January 1st, New Year's resolution, take a picture of that odometer. Now what you're going to need to track is you need to track your business miles, your commuting miles, and your total miles for the year, which would be personal miles for the remainder. But we need that because when we complete your return, we have to fill out those forms as kind of plug in, and also, as I'll talk about in a second, hold on, I'll get to that. I'll back up and get back to that. All right. Business purpose. If you're traveling, the primary reason for your purpose, basically meaning if it weren't for this business purpose, you wouldn't be making the trip, has to be for business. It's not going somewhere and incidentally handing out a business card to somebody and saying, oh, that's a deductible trip. It's probably not, but yes. All right, it's generally important enough to be on your calendar. That means if you're taking a business purpose, if it's a business purpose, you probably got it notated somewhere, you have an appointment. Okay, your primary reason is traveling for business. Now in 2022, which is when I'm filming this, actually 2023, but early, we're dealing with 2022 tax issues. You got a break in there, you got 58.5 cents through June, and then 62.5 from July through December. Just keep that in mind, technicality. All right, here's where another places where agents really mess up. Business people in general do, but you gotta remember, part of your deduction, if you're taking the standard mileage rate, is depreciation. That is basically 20 cents for each mile. It varies by year. That's 2022. 26% of each mile is depreciation on your automobile. What that means is you're reducing what's called your basis, and when you sell or trade that vehicle in, you could have a taxable event. Those are the rules. I'm sorry. Keep it in mind. All right. Here's the biggest problem with actual expenses. Now, if you get our tax cut library, you're going to see we cover everything you need to know, but this is just a real brief problem areas that we find out. All right, the deduction is based on the percentage of use. So if you're claiming actual auto expenses, the deduction that you get is based on your actual expenses times the percentage of business use. You know what that means? You need a log. Let's go forward. All right, now if you claim bonus depreciation, remember all that good stuff, you buy this certain vehicle over certain gross vehicle weight, bed length of a truck, certain distance, 6 foot in general, you can write that thing off. Bonus depreciation of 179. But this is what folks don't keep in mind. You write that vehicle off. If business use falls below 50%, part of that is going to be called recapture, and you're going to have to pay the taxes back. So just keep that in mind. Also, if you sell or trade in the vehicle, you completely write it off. You get a vehicle you wrote off, you'd go trade it in for another vehicle. You just have a taxable event if it's completely written off and it's worth something that you get the trade-in value for. Keep it in mind, it's an area that we see a lot of problems with. All right, let's talk about meals. Moving on to meals problem area. This is another issue we see. Now, 2022, 100% deductible for qualified business meals. 50% in 2023. You know, it's just how it is. Going back to that. But this is what we run into. This is an issue. What is a deductible business meal? I'm going to tell you this isn't always true, but this is a very easy way to tell if your business meal is deductible. Got 5 little steps for you, or 5 things to consider. Okay, the meal has to be with a business associate or a customer or client. At that meal, you should have a business purpose. You should be there for a business reason. You're not there just eating and then you're going to talk about business, or you're not going to chit-chat. The reason for the meeting, it's really a meeting where you're eating, all right? That's the reason, the business purpose of the meal. You have a business purpose to eat together wherever you go. It requires some level of preparation. So it's not just a regular meeting. You got to plan a little bit, think about it. You're there for a purpose. So it requires some level of prep. It's important enough to be on your calendar. It's not just willy-nilly, hey, where are you going? Let's go eat here. Let's talk about this one thing. Generally speaking, it has to be important enough to be on your calendar, and you got to pay for their meal as well as your own. Meals you have alone are 99% of the time, there is an exception, other than travel. There's another one that's in our book, but you got to pay for your meal as well as the person you're eating with. Okay, let's talk about the home office deduction. This is another big issue we see problems with. Now, basically for most for most real estate agents, you're going to use the home office basically to perform administrative duties. That'll qualify the area as a home office. That means you're doing your scheduling, your research, you're making appointments, place you keep your files, and you have no other fixed location to perform those duties. So basically, you don't have a permanent office at your brokers, that sort of thing. You have a home office. Now, to qualify for a home office, it must be regularly used for business. That basically means it's more than occasional use. That's what the IRS says. So it has to be continuous and ongoing, regular business use. So you got to use it pretty often for business. Here's the big thing. Only use for business. So if you have a spare bedroom at the in-law stay and you say, well, that's my home office, and then they stay in there once a year, that's not exclusive use. That's not used only for business. Now, maybe part of that room is used only for business, but this is what trips them up, real estate agents up all the time, small business owners in general. It has to be used only for business. All right, clothing deduction. Here's another big one. Let's talk about clothing. All right, here's the rules. Clothing suitable for everyday use is not deductible. 99%, I'm saying this just so you know, nearly always it's not deductible. If you're an attorney, you got to get a suit to go to be in court, not deductible. You could wear that thing to a wedding. Anything else like that. What Kramer's got on here, not deductible. Except he's on TV and that's the only place he uses it. Maybe it is as a prop, but not for you out in the public. All right, safety attire is deductible. Steel-toed boots, deductible. Vest, reflective vest, deductible. You do a lot of stuff out in the land selling vacant ground, and you got some of those big Kevlar boots to protect you from snake bites, probably deductible. All right, so if you want to deduct your clothes, this is what you got to do. You got to turn it into a uniform. How do you do that? You slap a logo on it. So here we go. Not deductible. Laverne with the L, if that was her business, that's her brand, that's her business, deductible. She just transformed that shirt into a uniform. That's it. That's what we're doing. So now if you have any questions in the comments section, you want to post them, ask us some questions. We'll do our best to answer you. And as always, thank you for watching. And hey, get our book, Real Estate Agent Tax Cut Library, available on Amazon. We'll throw a link in here for you. Thanks a lot and take care.